Evening, ladies and gentlemen. Welcome to the Rates and Lanes podcast. A little technical issue right out the gate. Uh, let's see here. Okay, now we're back up and right. So tonight, a little bit of a glitch. I was trying to get stopped so we could start the show and do it properly, but unfortunately, as fate would have it, I got caught up in traffic before I got a chance to pull over and get a chance to do the show. So I may be popping in and out, no big deal. But if you guys would do us a huge favor, like, share, and subscribe to the show. If you find any of the information tonight that we get into and discuss helpful or useful at all, by all means, make sure that you guys share the show. Tell a friend to tell a friend about the show. And I was looking, there he is. I was looking for my co-host. He just popped back in. Chuck Snow, good evening. How are you? Maybe he didn't pop back in. He's frozen. We got technical issues all the way around tonight. So let me put Chuck back on hold and let me grab Dean, because Dean is the man of the hour tonight.
Yeah, I'm good. Yeah.
Good deal. So yeah, Chuck is frozen at the moment. I'm not sure what his deal is.
That internet connection in his truck barn that he's got there might be a little bit sketchy. I think he mentioned that when I was up there having a look at his trucks. So it's all good. We can cover it. He'll be in shortly.
Yes. So Dean, with all the things that are going on, this is actually a great time to have you on the show. We just came out of a storm last week, very catastrophic for the people of Western North Carolina, some parts of South Carolina. I've actually been through Asheville and that part of North Carolina since the storm, and it definitely has taken a toll and taken a hit. When it comes to all of the things storm related, and we staring at another storm coming right down on the eastern seaboard again, Florida and the southeast.
Yep.
How much of an effect has this had on the market, and what can we expect before the storm and after the storm?
Yeah, the rates were, Rico, this is kind of very opportune that we're talking, because freight rates were moving up even before Hurricane Helene and Milton this week. So there was definitely upward movement in spot rates. So we've been seeing positive movement in rates for probably 8 weeks now, like not big jumps, but certainly positive. Here's Chuck.
Yeah.
So you're back?
Yeah, you know what? I just went on my my cell phone because my computer froze. I don't know if it's I think it's actually my computer, not my not my system here.
Yeah. So the summary of last week's rate movement, which was the first full week after Hurricane Helene's cleanup, right? So sort of that week post. It's really a strange phenomenon, because the volume of loads moving dropped about 3%, right? So the total volume of loads dropped about 3%, but rates went up 3% nationally.
That's a good sign.
So normally what happens when volumes drop, normally rates drop because there's less freight to move and capacity increases.
Right.
But rates actually went up about 3 cents nationally, but in the Southeast, they went up about 10 cents a mile because of what I'm about to say. So rates didn't increase because there were fewer trucks around. They increased because the trucks that were there moved a lot slower. So when you have heavy weather like this, your entire freight network slows down. When you have power outages, heavy rain, road closures, everything slows down. We saw this during the pandemic when we had trucks stuck on warehouse docks. The whole freight network slowed, and it forced freight rates up. So the summary of last week was volumes were down, rates were up, everything came to a halt. And I don't know that we've got back to sort of where the market needs to be. But from a freight flow perspective, but we didn't see much impact from the ILA strike, which happened at the same time.
Right.
So that 3-day strike didn't have much impact, other than it increased, load posts and loads moved in some of the ports. We looked at, there was about 20 markets that were in our freight markets along the Gulf and East Coast, they only represent about 20% of our load posts each week. So they weren't big markets, other than, Savannah and Elizabeth, New Jersey are big. Little bit of an increase there, but the ILA strike didn't, and I'm thankful that it didn't have a bigger impact, because that could have been devastating. It didn't have a big impact on the freight market. That said, there's still like 40 to 50 ships got to work their way through the port, so that'll take 2 to 3 weeks to clear that backlog. But what we're seeing, though, is this observable inflection in rates, and I think this next hurricane is going to make that even more pronounced, because of the amount of freight that's moving into these areas to help with the rebuilding effort. We're seeing, Chuck, from your part of the world, or a little bit further east from the Pacific Maritimes, New Brunswick, Nova Scotia carriers running a lot of lumber, dimension framing lumber, further south. So there's some colleagues that we know on social media that are busy moving that volume. So that's normally what happens, is there's this big influx. We're seeing pretty strong volumes of flatbed freight moving across from New Orleans and Houston in particular. So that's normally what happens. That's not unusual for that market to see a lot more volume move over that direction, because a lot of our freight, they're our big flatbed markets in that part of the world. So I'm seeing pretty good movement. Load posts out of Houston, for example, towards where Hurricane Helene landed, were up nearly 30% week over week. So, and like in Tallahassee, for example, the market was, noticeably impacted. And then you go to markets like the market where Asheville is north. It's called Greenville, North Carolina, and it was
South Carolina.
South Carolina, sorry, Greenville, South Carolina market. When we look at, and this is not going to surprise anybody, but the volume of loads dropped about 40% last week, which is, again, there's just nothing moving because it couldn't move. So,
right.
And so we saw a lot of market disruption last week. But I think that if you sort of pull back a little bit, there's a definite sense that since the last time I was on the show, which we didn't have really much news to talk about other than bad news, there is a definite sense that this market has bottomed out, and we're starting to see seasonality come back. And I say that because on our IQ show today, I ran our 35-day rate forecast, and we're starting to see seasonality happen at the start of November, right on cue. Because we're in this, normally freight rates after July 4, they kind of drop down a little bit and then they come back up. As soon as you see fresh turkeys moving, Christmas tree season, fall produce, Halloween, Columbus Day, Memorial Day, not Memorial Day. Yes, Memorial Day's coming up. And then leading into Thanksgiving, when you see all of these events coincide at the start of November, you start to see rates move up in a meaningful way. And we're starting to see that again this year, but for the first time in an observable way. Like last year, there was a little bit of a speed bump. This year, we're starting to see some pretty good rates for carriers, which is great news.
They need every penny of it, because they have a lot of red ink. It's going to take a lot of black ink to erase the red. Yeah.
Well, still, I mean, rates are still, the national average is still sitting around $2 a mile, including fuel. So that's still, better than it was in 2019, but we've still got much higher operating costs, as we've covered on the show before. So, Chuck, and Rico, I'm particularly worried about the Israel-Iran conflict, because diesel's gone up probably 4 or 5 cents in the last month after a long period of dropping. And diesel oil's gone up about $5 or $6 a barrel in the last few weeks. So the analysts are worried that if Israel attacks infrastructure and Iran starts to block the Strait of Hormuz, where there's 30% of our global liquefied natural gas moves and about 25% of global oil, that could have an impact on oil prices and the cost of oil. So that's one of the sort of things I'm watching, because that coincides with winter and the demand for heating oil. And a cold winter and a Middle East conflict that's affecting global oil supplies could force up the price fuel. And I mean, of course, the larger carriers get the fuel surcharge, the contract carriers, but I'm more concerned about the small carriers that get an all-in rate from brokers that don't have a fuel recapture program, because it takes a few weeks for rates to catch up once diesel goes up. Like, it takes a while for the market to adjust. So lots happening in the market, but there's definitely a sense that seasonality has returned.
The only thing is that I have noticed through the years is when diesel spikes up and oil spikes up, and the whether it's the broker or the shipper, he's just spent an extra $15 or $20 filling up his Dodge minivan. You ask for extra on fuel, they usually don't say no, because they felt the pain that morning filling up their own personal vehicle.
Yeah, so, and that takes time for that to flow through to the market, right, where rates start to rise. So that's part of it. I think it's that early period when, because retail prices take about 2 to 3 weeks to rise after oil prices go up. It takes a while for that to flow through to the market, and then they come down much slower. So that's sort of one sort of cautionary thing I'm watching, is that Middle East conflict. So far, all of the geopolitical risk hasn't translated into anything major. In fact, diesel prices have dropped. They're about 92 cents a gallon lower than last year as national average. So that's good news for carriers. But rates are definitely on the up. So I think we called the last freight recession at 49 months in duration. So if you remind all of our listeners that we talked about the last few freight recessions, 2012, 2013, 2016, 2017, 2018, 2019, and then the pandemic. Before the pandemic, they were 17 to 20 months in duration from when they start going up to when they start to bottom out at the next end of the cycle. So 17 to 20 months sort of puts the bookend on them. The last freight recession we've just had is 49 months. So rates went up for 22 months and they fell for 27 months. So that's why this has been an extraordinarily long period of time where it's been brutal for everybody, because it's been a much longer rebalancing of the market than we've ever seen before. And that's what's caught a lot of people by surprise, is the duration, because it's been particularly hard for brokers and carriers to weather the storm. And on the other side, shippers have had pricing power. Now, there was a data point popped out this week in our data that tells me that we're at the bottom of the market and things are going to improve. Remember on our last show, we talked about, because we just started bidding season, right, for contract freight. October 1 is when large carriers and shippers lock in their contract rates for next year. That's about 80% of the loads being moved. When you look at current rate negotiations between, say, a mega shipper and a mega carrier, in our business, and this is based on about 50 billion in annual freight spend, they're coming in almost the same as the rates they're replacing. So on our last show, rates were coming in, they were replacing last year's rates about 6% lower when I was last on.
Right.
So remember, during the pandemic, rates went up 12 to 15%. They went up for like 6 or 7 months, and then they fell at about the same clip. And on the last show, we were talking about how they'd slowed down to single-digit decreases. So what that meant was the rate of decrease that carriers were offering to shippers was getting smaller and smaller and smaller, to the point where in the last 2 weeks, it's almost down to zero decrease. So the rate decrease for big carriers and shippers at this point in the bidding season, where they lock in rates for next year, is indicating that rates now have bottomed out. No more discounts. Shippers are acutely aware that cheaper rates are no longer on the table, and that they're going to need to start adjusting their rates upwards. So we talked about this early in the year, where when spot rates bottom out, contract rates follow on 4 to 6 months. We've already seen spot rates bottom out, about a month ago. So if you take that, October, November, December, January, that's when you would expect to start to see contract rates materially start to increase. So I would expect that contract rates that move about 80% of the loads on all the high volume lanes will start to increase as we get into spring next year, which is about when we figured this market would start to turn around. So it doesn't mean the first quarter won't be tough, But there's those two data points, that spot rates have bottomed out and starting to rise, and contract rates for new RFP, request for proposal or contract negotiations have bottomed out and are reaching what we call parity, where shippers are no longer getting the discounts they were getting. So there's a real sense when you talk to big shippers that they're aware that this market has turned and that the last freight cycle is now in the rear vision mirror, and that any notion of cheaper freight in contract negotiations is out the door. It's no longer the case that they can bank on that.
Dean, have we done as an industry, have we culled the herd enough to create this? Is that what it took?
Part of it, yes. So part of it is we're seeing seasonality. There's a little bit more freight moving, not much, but a little bit more. But yes, the herd has been culled. The rate of decrease has slowed down. So when you look at the data, Chuck, it looks like the big exodus of carriers that were struggling has slowed down to a crawl, right? Yeah, because we'd been losing capacity since October of 2022.
Which we had to do that because we brought much capacity during the pandemic. Crazy.
So when I look at my numbers, we had 450,000 join from June of 20 to last month, and we'd had about 380,000 leave. So we still had about 13% of the carriers in the market, and that's why rates haven't moved up as much as everyone would have thought they would have or wanted, because there's been this excess capacity. And part of it, Chuck, is that there's still a lot of carriers there that still have pretty low levels of debt. They can afford to run for $1.50 a mile. And there's also, don't forget, there's a lot of large carriers are dropping trucks into the spot market. There's a lot more large fleets that get round trip rates, hauling for 80 cents a mile because they're already paid for the back haul anyway in their round trip rate. So that drives the market down even more. So lots of people have been looking at buying volume, and that's added to the complexity. The other part is the railroads have got plenty of capacity also. And big shippers save, when you look at the data, big contract shippers save about 30% over truckload on moving freight on an intermodal rail move. Now, of course, that's freight that can move slowly in the freight network. But again, our biggest competitor in trucking on the longer haul is the railroad industry, and they've got plenty of 53-foot boxes.
Yeah, and you know what? All the shippers have to do is hold some inventory.
Right.
They can tolerate the slower transit time through intermodal. As long as, now once we get into winter, my experience has been sometimes intermodal can bite somebody behind.
Right.
You get a train to somewhere in Wyoming, Northern Ontario or something, and
doesn't take much.
It can add a week on easily. Yeah,
well, you start to get tracks freezing, buckling, and you get derailment. So that's a wild card. We've had a lot. The shippers have been moving a lot more freight on their own trucks. That's been a feature of this year's market. They were pre-buying a lot of trucks ahead of the 2027 change in EPA regs. So there was a big pre-buy going on where private fleets were buying more trucks and moving more freight on their own trucks, which meant less freight for typical for-hire carriers. So there's been a lot of stuff going on in the last year that has just meant less freight volume for too many trucks. So that's sort of been the feature of this year.
Do you see much activity with the private carrier shedding some of their assets? Because I know that, talking to some of them, they never even wanted to start running trucks, but they were forced to during the pandemic because they weren't $5 a mile. They knew, and I guess I can mention the name, Walmart being one of them. The costs, and they're big enough to do round trips. That's
definitely happening where they're pushing more freight because it's uneconomical when you look at the numbers. The cost of running a private fleet versus a for-hire carrier when rates are so low, doesn't make a lot of sense. So yes, our friends at ACT Research noticed that the rate of buying of trucks in the private sector slowed dramatically in the last couple of months. But Chuck, what did pop up was vocational trucks was the big number in the Class 8 buys. So that's your short haul regional day cabs. It's really interesting to see that sector growing, which again kind of fits the The other thing you just sort of touched on it. We've seen there's a glut of warehousing now that's emerged. So which is like, you think, wow, surely we saw this coming, and of course we did. The same as we've now got an excess of chassis trailers and 53-foot intermodal boxes, and the whole industry, purchased way too many assets during the pandemic, and we're still to a degree going through the rebalancing of all of that. Like, the market is still readjusting itself, and when I say we've seen seasonality return, that's a pretty big deal, because normally in the trucking market, when you were running traffics, like seasonality, you could almost bank on it.
Like right around this time of year, we would start moving freight for Christmas.
Yeah. So we're starting to see seasonality return after an absence of probably 3 to 4 years in a meaningful way, where it's starting to happen pretty much on schedule. Now, again, this year we've had a lot more volatility because of the ILA strike. Shippers bought in their inventory a lot earlier. So they were about a month to two earlier. And that has been sitting in all of these warehouses, that there's plenty of them now that are looking for inventory. So there's been a pre-buy, particularly on the West Coast, where people have been, buying their imports, bringing them in a lot earlier than they would have normally. So the shipping season has happened a little bit earlier than normal, and that tends to flatten out the peak that you would have normally seen at traffics. So, but it's still there. Like, we'll still see pretty good volume. I think shippers have there's a lot of last minute replenishment of stock going on in stores. So we'll see a lot more spot market activity, because shippers are sort of reacting. They've kept inventories as lean as they can.
Well, they've had to, because money got expensive.
Yep.
And if people aren't buying product, don't restock the shelf with hundreds of that SKU.
Yeah.
Buy 10, pay more for trucking, and pay less to have inventory sit.
Yeah. Yeah. So that's, I just noticed national warehouse occupancy rates hit 6.3% this month. But that's back to where it is. That's the long-term average, is about 6.1%. So that'll be an interesting feature. They don't expect the warehouse market to stabilize, where they get sort of back to supply and demand equaling itself until next year. But
do you think it'll happen that quick? I got to tell you, like, we've been up here, like the millions of square feet of warehousing that they have built in the last 18 months is mind-boggling. Square feet. Now they're all empty because they're brand new. They're not even finished yet.
Yeah. It's a great question.
How long it takes to fill those up?
Yeah, it's going to take a while. I think you're right, Chuck. So the other thing that we saw this month, to piggyback on the thought that rates are starting to move up and we're seeing seasonality, I looked at 4 data points that tell us that tonnage for trucks is starting to improve. The Jason Miller's truckload ton mile index was up about 1% in July, which is great news.
Really.
It's sitting exactly where it was in July of 2018. Now, remember, July of 2018 was the peak in that freight market, and then it started to go downhill.
By August, it had already.
Yeah. I remember we got into that third quarter and we're seeing record numbers in new truck orders, and I said, hold on. That's not the market that I'm seeing for the next year. And of course, we ended up with way too many trucks. But so we've got more trucks than we had in July of 2018, but tonnage is about the same. So that's sort of one data point that tells you where the market's at. And of course, interest rate cuts should stimulate the trucking economy as those cuts flow into the broader economy next year. So capital investment will obviously improve that. No doubt you're going to build a new building for your trucks, so you're going to help add to the economy.
Well, every bit helps.
Every bit helps. Yeah, I need to build one too. So truckload ton mile index up, which is great news, because it's been faltering. It hasn't been showing a lot of meaningful movement. ATA truckload tonnage index. So this is not spot freight, but this is just straight up contract freight tonnage, up 1.4% in August, up about 1% compared to last year. So again, it's the second month that tonnage has climbed. We're seeing the same thing on 2 or 3 data points. The ACT Research for hire trucking index has increased 5%. It's got a little bit more intermodal and LTL in the index, I think. So again, that's another data point that showed we're up. And the other part, the ISM Purchasing Managers Index that comes out at the start of each month. The good news is it was flat compared to the prior month, but the better news was that new orders increased about 1.5 percentage points. So if you look at all of the data points across the spectrum, they're all starting to show some upward movement, which again is what we normally expect this time of the year when we get into the busy shipping season.
Well, we need it, it's been so flat for so long or downhill for so long. Everybody is just waiting for that.
Yeah, I was going to hopefully be able to pull up some Canadian data just to see where we're at there. I don't know that I've got much. If I look at your big market there, of course, is going to be Ontario. Yeah. It's going to be Toronto is probably your biggest market.
By far.
Yeah, by far. Toronto, volume's down about 1% last week. Rates are up, though, Chuck. So I wonder if capacity is starting to tighten. Rates are up. Outbound rates out of Toronto were up to $2.21 a mile. So they're up about 27 cents last week.
That's fantastic.
Yeah. So part of me wonders whether your strike action, the Montreal strike action, and we saw a little bit of volume come in through because of the strike action. There could have been some more volume, but there's definitely some positive signs there on dry van in the Toronto market. Hang on, let me just make sure I got this right. I'll look at a couple of the other markets just to make sure I'm seeing the right thing.
That's really strong in this entire country is Montreal.
Yeah. So you've seen, rates are up 11 cents a mile out of Toronto. They're up a little bit more out of London and out of, what was the other one you said? Montreal, Quebec?
Montreal is because Quebec has an awful lot of industry.
Yeah. Okay. So would it be more of a flatbed market?
Both, because Quebec was very, very smart years ago. They offer better priced hydro,
right,
than Toronto does or than Ontario does. So manufacturing is because you can operate a plant so much more cost effective because your hydro is such a big operating any manufacturing plant.
Right. So van volumes out of Quebec slid last week. So compared to last year, they're up about 15% in terms of the loads moved. Rates are up about 7 cents a mile or 4%. Refrigerated volumes are up 7% last week. Reefer rates out of Quebec are up 26 cents a mile last week to 209.
There's a lot of produce grown outside of east of Montreal. You've got a lot of broccoli. You've got just all the regular stuff. So the real push for there, same as anywhere else, the produce season. Yeah,
flatbed. Not so much on the flatbed side. I don't see I don't have enough data to tell us what flatbed's doing out of there. So,
going on to what you were saying before, I think we'll see a real increase in rebuilding efforts.
Yeah.
There's a lot of wood comes out of Quebec.
Yeah, I remember my colleague last week, Bobby, said, in a rather, crude way, we need a good hurricane, right, to rebuild, which is never a good thing to say, but that's how they look at the lumber market up there. Whenever they see hurricanes, they see a lot more lumber.
I hate to say this, but there's, and please, forgive me, but unfortunately, somebody said to me once, and it's true. There's money in misery. Whenever we have catastrophes, they have to build.
Yeah. I mean, on the news tonight, you're seeing all of these dump trucks down in Florida lining up, like miles of dump trucks, triaxle dump trucks, and they're shoveling debris from homes from Hurricane Helene to try and get it out of the way so it doesn't become a missile tomorrow night. So truckers, and there's been guys out there delivering fuel today to gas stations. So this is I remember in, if you go back to the 2017, 2018 freight cycle, Chuck, so 2017, December, we had ELD mandate. Yes. And then we had Trump tariffs come in. We had a change in the tax law, accelerated depreciation. we had economic stimulus and we had an oil price rally. But before that, in September of 2017, we had Maria, Jose. There were 2 Cat 5 hurricanes. There were 4 big hurricanes in September, and there were 2 big Cat 5s. I was working at FreightWaves at the time, and the rebuilding effort from that month and into October kick-started the freight rates, in particular in flatbed, that never came back down until about September of the following year. So we really saw that big hurricane season in 2017 as the catalyst for the rest of that rate rally through 2018. And in flatbed, we're seeing exactly the same thing happen with rates. They're tracking with 2017 rates almost identically right now. And that could be coincidence, right? But
well, you know what? It's funny you say that. No, part of it's coincidental. And we've always said, when you've had a downturn, the first thing out of it, is flatbed. Flatbeds are the first to get slow and the first to get busy.
Right.
Okay, and we are the trucking industry. We are the canary in the coal mine. Right. When it comes to just the economy in general, and then we've had these catastrophes. This hurricane coming in now, Milton and Helena last week, and then other ones that
lining up
bad, but they still cause damage.
Yeah, the flooding. Yeah, I mean, this is it's terrible to talk about it, but there's an inevitability about what's going on, and particularly the intensification of these hurricanes is causing a lot more damage than I think most people had anticipated. But you touched on something a little bit earlier about uncertainty about next year, and I think we sort of have a little bit of that concern too, because I think the clean out of capacity, both on brokerage and truckload, there's been a lot more. There's been a lot of people leave the industry for all sorts of reasons. But I sort of touched on it, the 2018-2019 cycle, there was some really extraordinary things happened, like tax changes in the tax code, ELD mandate. So that started that rally. And then we had the pandemic, right? So go back to 2016-17, that was a fairly normal freight cycle, as it turns out.
You're right.
We had a really bad industrial economy. Auto parts industry was hit pretty hard in the Midwest in 2016. 2017, it kind of recovered. So my boss said the other day, he said, I think we're on the foothills of the market is shaping up a lot like 2016, 2017 did. 2017's shape. Now, if you remember that, rates didn't go up a whole lot, but there was some cyclicality to it. And the reason he said that, and I tend to agree with him, he said, because what is it that's like the pandemic or the ELD mandate or changes in the tax code? Like, what is it that's going to disrupt the next freight cycle? Like, what's that big event? Because the market doesn't turn because trucks left the market. The market turns because there's a significant event. Now, we may be on the back door of that right now, right, with these hurricanes. That could be it. But absent that, there's nothing from an economic stimulus perspective that says that this market's going to take off and suddenly we'll have more tonnage, because I think people are probably still going to spend as much money on services, right? You and I are going to Australia. We're spending money on airfares for our conference next year, right? So during the pandemic, people spent a lot more on physical goods than they did on services, and we had more freight to put on the back of our trucks. We're not seeing that now. People are spending as much money on services as anything else. So what we're trying to figure out is, because when you look at the last 4 freight cycles, they've grown in amplitude. Like, so the rate increases is much higher on the way up and much lower on the way down. Like, there's been a much more volatility in the last 2 cycles, but they were both pretty extraordinary when you look at the things that drove those markets. And what we're trying to figure out is what's on the horizon that's going to change our perception or change the reality of this market. And we just don't see anything. Take hurricanes out, there's nothing that we see from an economic stimulus or anything going on that could change this market fundamentally, other than just normal seasonality. So that's why it looks like, when you look at the shape of rate forecasts, it looks a lot like what 2017 did in terms of the way it'll go up and down, rather than this sort of Mount Everest type spike in rates and then this calamitous fall on the way down. I don't think we'll see that again unless there's some, massive geopolitical risk that upsets the entire market.
They'll stay between two lines. One being that, like let's say it's a $1.90 and the being 2.10, and it stay between that 20-cent variance.
I think you're right. So I would say that it'd be really good advice for anybody to budget on this year being next year being much the same as this year, because rates this year are very close to last year. So there hasn't been a lot of significant movement year over year. Like, they're tracking each other seasonally pretty well. So I think, cost control is going to be the big thing. People are going to have to find a way to eke out a margin. And of course, it would go without saying that whatever profits you make this quarter, sock them away in the bank, because I think the first quarter, again, is always going to be tough, assuming the market turns in the spring.
Well, in a normal year, we always, this was a normal year for me for 40 odd years up until really the pandemic. It was all seasonality.
Right.
And right after U.S. Thanksgiving, last Thursday in November, just before that, shelves are full and that's it. Things start slowing down for Christmas, and we don't get a lot of action until the ice starts to break on the lakes end of February, beginning of March.
Right.
And that's when things all of a sudden start to turn.
Mm-hmm.
Of course, during a boomer year, you're going right up to Christmas Eve, because people, I remember years and years ago, I don't know if you remember this contraption. I think Philips and some of the electronic manufacturers came out with these air fresheners that were the size of an old transistor radio, and they had a fan on them.
Right.
They were a hot seller like 40 odd years ago. And I remember we were delivering the damn things the day before Christmas Eve because they couldn't make enough of them.
Right.
Like that. And that we were delivering enough of them where, we didn't have a bad December.
Right.
Because there were enough of them. And there was always something. You get a normal year and there's not a whole lot happening.
Right.
And I think we're back to where we always were for years and years with you're 100% right, with the seasonality.
Yeah, I'm just, and I think it's probably worth talking about that. With that seasonality comes a lot of opportunity for carriers in regional areas, right? So we're seeing, I'm just trying to pull up my rates for the Yakima Valley, because we start to see fall produce intersect with Christmas tree season out of the Pacific Northwest. Reefer rates in particular, I'm just going to look at, they're sitting at about 239 right now. But when I go to my forecast, so let's call it 240 a mile in the last 7 days for Yakima to Los Angeles. That's 1,037 miles. So that's a couple of solid days' work. And the forecast so if it's at 240, they're going to peak at about 249 by Thanksgiving. So there's another probably 10 cents a mile in rates to there. One of the big lanes out of there is Fresno, and Fresno out of the Yakima Valley is going to peak at about 234. It's sitting at about the same there. So rates are starting to move up. So that's consistent with fall produce. But and this is why I talk about this, because this produce season, when you start to get into the Pacific Northwest and you get Christmas trees moving nationally, fresh turkeys start moving 3 weeks out from Thanksgiving, about the same time that Christmas trees start moving. Right. They're two things that start to move the national rate needle up.
Sure.
And that's what we're starting to see, is this really pronounced seasonality in our rates, where you'll see refrigerated rates jump 20 to 30 cents a mile on a lot of lanes in that first 3 weeks of November. So those listening need to get ready for that, because it's not all doom and gloom, because I think there is opportunity. There'll be lots of opportunity, of course, in moving freight into these areas that are hardest hit by the hurricanes. But outside of that, there is seasonality in some of these markets that are pretty attractive for carriers that have got the right gear.
They've got to be able to. The hardest part sometimes is getting into those areas during those boom seasons. Right. I know that the shippers up in the Toronto area, that I used to deal with, would give you these rates all year round going into places like Miami, and they would pay extra. Right. And then season came, out of Miami or out of South Florida, which isn't much anymore, but it used to be a lot more.
Right.
Guys would go and give the freight to some guy that would do it for 80 cents a mile.
Yeah.
You know,
Yeah.
and that's how some of these shippers behave, because they don't look at it as a partnership.
Right.
Dude,
Yeah. I think I'm looking at, so, like flatbed's always an interesting one, right? Flatbed, you were talking about flatbed a bit earlier. Flatbed rates are sitting, you're not going to believe this, Chuck, but Texas flatbed rates are even higher than where they were in 2020, like at this time during the pandemic when things are really starting to get busy. So, Texas was, if you're at a Southwest carrier, there's some really good opportunity there in the Southwest around Shreveport, Mississippi, Louisiana, Texas. Like, there's that Southwest region has always been really strong. Medford, Oregon, like there's always a tightness of capacity in Medford. Rates are at $267 a mile out of there right now.
So out of Medford, it's kind of in the middle of nowhere.
Yeah.
Is that all lumber coming out of there?
Yeah.
Probably for rebuilding efforts, because my understanding is the housing market, as far as building new homes, it's not like people are obviously the construction companies are living out their they're following their contracts and they're building, but there's new developments happening.
Yeah, so I'll give you an example. Medford, one of the big lanes out of Medford is Medford to Stockton, right? So Medford to Stockton's that's not a big haul. But let me pull up. It's probably more like because that's Medford's at the southern end of the valley, right? That I-5 valley, Medford to Stockton. Stockton's a pretty big freight market just outside of San Francisco. It's 355 miles. So you got to know what you're doing to do a turn in a day. But rates are at $380 a mile now for the 355. So what's 3.80 times 355? That's $1,300. So that's almost round trip. If I divide that by 700, that's $1.92 round trip. So maybe that's what that rate's reflecting there.
I think that's what it is, because the guys don't, on those short trips, that's why they like them, because they get better fuel mileage when they're running empty.
Sure. And so rates, so out of Medford last week, right? So give an example on some of these lanes, Chuck. Volumes are up 44% last week out of Medford to Stockton. Rates are up 43 cents a mile. They're about 10 cents a mile higher than last year. So there's a really strong market for flatbed carriers right there. But anywhere in the Southeast has always been a good market for flatbed carriers. Like, Alabama, one of our biggest flatbed markets is the Birmingham market.
Well, that's because of steel, correct?
Yeah, right. Yeah. So where most of our steel's made. So, and a lot of our highest volume flatbed lane out of Birmingham is Lakeland, where this hurricane's about to hit. Of course, that's Orlando and Lakeland. A lot of flatbed volume comes out of Lakeland also, but volumes, rates are up about 12 cents a mile last week on Birmingham to Lakeland. So I think that if carriers are savvy about this, even though the national averages are not exciting, if you think about the national average for flatbed is $2, well, Birmingham to Lakeland is $2.72. Right. So there's good lanes and bad lanes. There's some head haul markets, but I think the thing to watch though with this hurricane season in the Southeast is you see a lot of lane imbalance, right? Where volumes just shut down completely because they're underwater or out of power. So you get a surge of volume one way and nothing the other. So you've really got to be understanding your operating costs and the conditions. So
when you go into these zones, you take your backhaul with you.
Yeah.
You've got now, Dean, on another total. Rico and I were talking earlier on today, and he's quite interested. There's a lot of talk, and I have my own opinion on this, but I want to hear yours. Apparently there's a lot of chatter on social media with drivers or owner operators talking about striking. Now I can see it clear as day. Or here, people that work off the piers.
I saw that. Yeah,
they can do it because they have they've got, number one, the expertise. They've got the contracts. They all work together. They work off a pier. Whether it's Charles, whatever the pier is. That's their own turf. They run within 100 or 200 miles from there. What are you hearing? What are you seeing? What are you thinking?
Yeah, I saw the same thing. The other thing though is that to add your point, they've got TWIC cards, so you've got to have your access cards to get onto the port. So there is a lot more unity in that community. So I saw some of the social media posts. Sometimes we're our own worst enemy.
We always are.
Right. So who's hauling the cheap freight, right? Like, so it's not DAT, it's not Chuck Snow, but who is it? And I always remember, so I never forget this conversation with a guy that owned a truck fleet. He was at Mid-America Truck Show, and I was down there showing my truck this year. And he said, I'm part of the cheap freight problem. And I said, how do you mean? He said, well, I get paid round trip and I get paid really well. But when on my backhaul, I go and chase freight. And I'll do it for pennies. If it doesn't take me too much time, I'll throw a load on for 50 cents a mile. So, a cheap rate to some people is pure profit, whereas to others, it's make or break. So this is a really fragmented industry, but I think in your example there of the port workers, they're a pretty unified group, and they've probably got a better chance than any of trying to get something. But I still come back to, it's a free market, and we're our own worst enemies when it comes to sticking together.
100%. And I've seen the I've seen the cohesiveness at the ports. I know that in British Columbia, those port truckers, when they say we're not moving, I don't think anybody's stupid enough to go against them.
Yeah.
How do they want their truck and their face packed? As far as the general long distance trucking industry going on strike, that ain't gonna ever happen,
right?
Unless we went back to Teamster days or a serious union, which is still not going to happen because, as I said to Rico, how long can people? They're making truck payments. Even if you're not, you still have expenses. Unless you're a great manager, you have expenses and you don't have a pile of money in the bank.
Well, the strange thing is that you would have thought they'd be much busier and making money. That's what I'm kind of surprised at, because September's imports came out on Monday, Chuck, at a record high for the month of September, 2.6 million containers.
It's not the volume they're complaining about. It's the price they're getting.
Yeah, right.
That's what they're complaining about. It's the volume. It seems to be fine, right? Because, as I said to you last week on one of your posts, all these ships, I forget how many TNUs are on them now. Is 8,000 or something on some of them?
Yep.
That's a lot of containers that have to be delivered all over the place.
Right.
So I don't think there's any shortage whatsoever of work. It's just how much these people are getting paid, and now having to, it's harder to get in and out of those ports.
Well, we'll have this same discussion in February when we're in Brisbane, right? Because it's the same economics. It's the same, like there's the undercutting, there's the rate cutters, there's the different demographics that come in and they want a new broom sweeps clean, and they come in and promise a shipper a better rate and a better service and do it for cheaper and then fail on service. Some make it, some don't, but heck, that's the industry we're in.
Dean, I've been seeing this for, as of Saturday, 50 years.
Yeah.
Right. And the best example I can give to anybody is probably the most beat up lane in the entire world, which is Montreal, Toronto, Montreal.
Right. Yep.
And some of the rates today are much less than they were way before I got into the business.
Right.
Okay. And this is like, I've been in it 50 years and I've been told by an older fellow that it was 14 years before I got into it, 1960, there was a transport company called Smith Transport.
Right.
And wouldn't take a full load from Hamilton, Ontario, which is about 35, 40 miles the other side of Toronto going towards Buffalo, New York. It's, I guess, southeast of Toronto, because the lake turns everything around there, to Montreal. They wouldn't take a full load for $1,600 in 1960. Okay. Right. So that was somebody that worked there. And today you wouldn't get $1,600. Okay.
So Chuck, I'm just looking at the rates. Toronto to Toronto to Quebec is paying $606.
There you go. We were getting more than that in 1974.
And on the way back, on the return, it's the 7-day rate's $1.78. So it's like $1,200 for 700 miles.
From Toronto to Montreal round trips is roughly like center to center is 350 miles.
Right.
But
Okay.
There's not a lot of manufacturing in the city of Toronto. There's a little bit more in Montreal, but still, everything usually happens on the outskirts. You can probably add another 50 on that anyways.
So that's $1.72 round trip.
It's insane. And we're paying right now less the HST, but it's somewhere about $1. I'm going to guess about $1.30 a liter without our HST for fuel. Yeah, that's how. And drivers get paid well here.
Oh, they do? Yeah.
Yeah, they do okay.
Okay.
Yeah, you have to. If you hire cheap drivers, your trucks end up in the ditch.
Yeah. Like, well. Hey, I've done a bit of traveling since I saw you last. I was in the port of Los Angeles. This was fascinating. I don't think I spoke to you about this. I went up to the Coast Guard on the headland. That's like an air traffic control center.
Wow.
So the Marine Exchange is a 100-year-old organization that back in the day, in the early 1900s, when a ship was coming in, these guys called runners would run up to the hill with flags and communicate with the ships. And what they did, they had 5x8 cards with all the ship details on it. And that's how they would manage all the vessels in and out of the port of Los Angeles, because it was big in oil and lumber back then. Like, so it was one of the biggest ports for oil and lumber.
Right.
Fast forward to today, it's a joint venture between the Marine Exchange and the Coast Guard. But I sat in the control center with the Coast Guard guy, and it's a wall-to-wall screen with all of the ships, the lat long, the plot of the ships, and all of the details. Like, it's like an air traffic control room. And the guy is talking to the captain. Like, he calls the captain up, and it's just like a pilot talking to the ground control. And he was saying, have you done your rudder check? Is the pilot line down? Here's your heading. Here's your speed. Here's your intercept point with the pilot. And what they do is they schedule all of the pilots and the tugs.
Right.
So that's how they know when to send the pilot out and when to have the tugs ready to bring them in. So go back to the pandemic. Remember when we saw all of those vessels at anchor all off Los Angeles? Yeah. These were the guys that did all the scheduling of all of that. And I met Captain Kip Loudon. He's the guy that hosted me. He's an ex-US Navy Coast Guard captain. And I got to tour around this center, and I'm up on the headland watching these massive ships come in from Shanghai into the port and unloading. And that's what got me thinking about it, was your comment about how tight-knit the truckers are on the docks. Yeah. Like, this is a pretty tight group, so I wouldn't want to cross them.
No.
But yeah, it was a great experience. I was so excited to see that, because I'd wanted to see. He was the guy. In fact, Kip's wife was the one that built the schedule to slow all the ships down all the way back to China, so they didn't end up at anchor. Remember the term slow steaming?
Yes.
Slow was what they said is, we've got a massive amount of congestion here in Los Angeles. You can either come in and wait for 3 weeks, or you can slow down. And
if I'm not mistaken, did the steamship lines not profit by running slower?
Oh, yeah. Yeah. Now, they got less volume because they were doing fewer trips, but yeah, the rates were higher. So yeah, they burned a lot less fuel. So absolutely. Yeah.
They were a lot higher. I remember some of my customers were paying like crazy amounts of money for containers, like $15,000 for a container from China that's usually $3,000.
Yeah. Yeah. So yeah, this is that was the start of my week last week. I was out speaking at the England Logistics Conference. Then I went to Omaha and I got to see C.L. Werner's old trucks that you would have seen on Instagram.
Did see that, yeah.
That was cool. It was a pretty quick visit because I had people hovering around and we had to go, and I didn't get a chance to sit in all of the trucks, but the cab overs were great, like the 359. The Freightliner, I would have loved to have had more time in that classic Freightliner. That's just a spectacular truck. But to see CL's old, is it an F800, the first truck he purchased, the red straight truck?
He still has his first truck. Wow.
Yeah, that was that red one in the corner.
Right.
I put an 8-minute video up on YouTube on my channel, and I sort of told the story about that was his first truck that he purchased at age 18, and built the fleet from there. Just a great story. I've never met him, but I'm always fascinated by some of those old trucks in that building, because my truck is ex-Werner, so I have a sort of an affinity to them.
That was not a company truck, though, was it?
Mine.
Yours was?
Oh yeah, it was a team truck. Had bunk beds and everything.
I'm shocked that they would buy something that.
So back in the day, early 2000s, their best drivers were getting the best equipment.
I always thought that when I saw those Peterbilts,
Yep.
I always assumed those were owner operators.
No. So they had a bunch of them, all different colors. And I tracked the history, and I talked to Dwayne Hogue. He was the head shop manager at Werner at the time before Guy Welton took over.
Right.
And I got the history on the truck. And that's what they were doing back then, is their best drivers, their multi-million mile drivers were getting some of the nicest trucks.
Wow. You know what? I always assumed, because I'd see these trucks with Werner, I thought, well, that's just, the guy leased on there.
Right.
What a story. All companies started out with one guy driving one truck, every one of them.
Yeah. It's a great story. They don't do much with the museum there. It's got probably 8 or 9 trucks. They don't do much with it. I'm a little bit surprised, but then I think it's because that history is kind of fading, as that they're a public company, a whole new breed of drivers. Because I asked the lady that was taking me around, I said, aren't drivers itching to come and look at all these trucks? And she said, no, not really.
Not the new drivers, because they can't relate to them. No. I remember hearing a story, reading about Clarence Werner, and on his business card it said chairman and driver.
Yeah, right. It's a great company. I love Werner. I first visited them in 1997. When I spoke to the group at the conference, I said I was here in 1997 because I had to get away from my wife's relatives in Indiana. So I got a rental car and took off. And I knew a guy at Werner from, they were working with Qualcomm and trying to get Qualcomm into Australian fleets at the time. So he showed me around their whole installation, and I was just blown away. So they're wonderful people. I really like the company. But the history there seems to be missed. But I did get a chance to go down to the Greater Omaha Packing Company and talk to some the bull haulers, all the cattle pot guys. There's not one new truck amongst that lot. Like
no. I have to tell you, I love Omaha, Nebraska. It's one of my favorite cities in your whole country. And by the way, Omaha, Nebraska has one of the best sushi bars anywhere, and it's called Blue.
Okay.
And when I was lecturing for Kevin Rutherford and doing mentoring at his annual shindig over the bridge in Council Bluffs, Iowa, I would sneak out every night and go for dinner late at night and go to Blue. Great, just a great place. Dean, I'm looking at the time.
We gotta go.
We're going to run out, and I want the listeners to know how to get hold of you.
Yep. On social media at the Grumpy Pete, you can DM me there. LinkedIn, Dean Croke on LinkedIn. I'm always available on LinkedIn. Any specific questions, you want any charts, askiq@dat.com. That's the email, askiq@dat.com. Happy to send you any information I can.
That's great. Dean, I really, really appreciate you joining us tonight. You bring so much information, and I can't wait till we go to Australia.
Yeah, you're going to love that.
Can't wait. Hoping to get to see a little bit of the Outback.
That'll be nice. We don't have to go too far.
Dean, thanks again. And
thanks,
listeners, listen, those people that are going to be affected by this hurricane, we pray for you. Please get out of harm's way. You're not safe at a truck stop because things are going to happen. So get the hell out of Dodge while you can, if you've got enough fuel. And on behalf of Rico Muhammad, this is Chuck Snow, the Rates and Lanes podcast. And as Rico always says, Keep it between the mustard and the mayonnaise. And as I always say, catch on the flip-flop. And we will see you, God willing, and the creek don't rise, same time, same place next week.
Gotcha.
Thanks a lot. And Dean,
Bye-bye.
thanks again. Look forward
Thank you,
to
Chuck.